Let's talk about Unilever, a company you know even if you don't realize it. Unilever is one of those names that quietly shapes our daily lives, often without us even noticing. It's a company that's been around for generations, woven into the fabric of households across the globe. Dove soap, Ben & Jerry's, Lipton tea, that's Unilever. Their brands fill our kitchens, bathrooms, and freezers, making them a constant presence in our routines. This global giant is a staple in our homes and a classic blue-chip stock, stable, reliable, and trusted by investors for decades. For many, Unilever represents the kind of company you can count on, both as a consumer and as an investor. But even the strongest companies aren't immune to market shifts. The financial world is always changing, and even household names can face unexpected challenges. Recently, on February 17, 2026, investment firm Kepler Cheuvreux downgraded Unilever's stock. This kind of news can make headlines and spark concern among investors. A downgrade sounds alarming, but it's not a disaster, just a signal to pay attention. It's a reminder that even established companies face scrutiny and must adapt to changing conditions. It's not about Unilever's business failing. It's about what analysts think will happen to the stock price soon. Analysts look at many factors, from global trends to company performance, before making these calls. Understanding this difference is key to being a smart investor. It's about separating the company's real-world strength from the ups and downs of the stock market. Today, we'll break down what this downgrade means, why it happened, and how you should respond. We'll look at the bigger picture, not just the headlines. This is a chance to learn how the market works, so you can act with confidence, not fear. When you understand the reasons behind these moves, you're better prepared to make smart decisions. We'll cover the reasons behind the downgrade, the terms you need to know, and what it means for your money. You'll gain insights that help you navigate not just this moment, but future market news as well. Let's turn this headline into a lesson in financial control. Ready? Let's dive in and discover what really matters for your investments. So, what is a stock downgrade? It's a term you'll hear often in financial news, but it can sound more dramatic than it really is. Think of it as a report card for a stock, not the company itself. It's a way for analysts to communicate their updated view on how attractive a stock is at its current price. Analysts at firms like Kepler Cheuvreux spend hours researching companies, digging into financial statements, industry trends, and market conditions. They issue ratings, buy, hold, or sell, based on all this information. A downgrade means they've shifted their opinion for the worse, usually from buy to hold, or hold to sell. It's a signal that the stock may not offer as much upside as before. It's not a command, just an informed opinion. Investors are free to agree or disagree, and many use these ratings as just one piece of their decision-making puzzle. In Unilever's case, the rating moved from buy to hold. Not a disaster, just a signal to pause and reassess. It's more of a yellow light than a red one. Why do downgrades happen? Sometimes it's slowing sales, new competition, or economic shifts. Other times, it's simply that the stock has already performed well and there's less room for further gains. For Unilever, it's different. The stock price has already climbed, so analysts think most of the good news is already reflected. They're saying, don't expect the same growth from here. A great company doesn't always mean a great buy right now. Timing and price matter just as much as quality. A downgrade is like a movie critic saying, wait for streaming. The quality's still there, but the urgency is gone. You might still enjoy it, but maybe not at full price. It's a prompt to reevaluate, not panic. Smart investors use downgrades as a chance to review their own research and see if anything's changed for them. Remember, information is power. The more you know, the better your decisions. Use it to make smarter decisions. Stay curious, stay informed, and don't let headlines alone drive your choices. Let's see what these ratings really mean and how you can use them to your advantage. Let's decode Wall Street's language. Buy, hold, and sell. These terms are more than just labels. They're signals that guide investors through the ups and downs of the market. Understanding what they mean can help you navigate your investment journey with more confidence. Buy is a green light. Analysts see big growth ahead and believe the stock is undervalued or poised for a strong run. Sell is a red light. Analysts expect the stock to drop, maybe due to weak earnings or negative news, and recommend getting out before losses mount. Hold is a yellow light. Neither a rush to buy nor a warning to sell. It's a signal to pause, reflect, and watch how things unfold. Recently, Unilever was downgraded from buy to hold. Not a red alert, just a suggestion to wait and see before making any big moves. A hold means analysts expect the stock to perform steadily, in line with the market, rather than outperform it. If you already own shares, it's a sign to keep holding. If you're thinking about buying, it might be wise to look elsewhere for better opportunities, at least for now. The shift from buy to hold is about adjusting expectations, not losing faith in the company. It's a move from exciting growth to steady reliability. Sometimes companies enter a phase where growth slows, but stability remains. Understanding these signals helps you make calm, informed choices. Don't let a yellow light scare you. It's just a cue to slow down, reassess your strategy, and avoid making hasty decisions based on emotion. The real risk is reacting emotionally, not rationally. Staying level-headed is key. Let's look at why Unilever got this new rating and what it means for investors like you. Stay focused on the bigger picture. Remember, investing is a long-term journey, and understanding these signals can help you stay on course. Why did Kepler Cheuvreux downgrade Unilever? Simple, limited, near-term upside. That means analysts don't see much room for the stock to climb higher in the next few months. It's not a long-term judgment, just a short-term forecast. Upside is the potential for a stock to increase in value. Right now, Unilever's price reflects its current value. There's little bargain left. Think of it like a house priced exactly at market value. No quick profit to be made. The downgrade isn't a criticism of Unilever's business, just a reflection of its current valuation. If analysts see little room for gains, they shift from buy to hold. It's a logical move when the stock price has already captured most of the good news. The company remains strong, but the easy gains may be over for now. This is about timing, not company quality. A hold rating is a responsible update, not a red flag. Let's see how this plays out in the market. Buy the rumor, sell the news. That's Wall Street wisdom. Stock prices often rise before good news is officially announced, as investors anticipate success. By the time the news hits, the price may not move much. The good news is already priced in. That's what happened with Unilever's strong performance, led to steady buying, pushing the price up. Now, analysts see the stock as fairly valued, no more hidden bargains. The recent run-up means the easy gains are likely behind us. The downgrade to hold reflects this reality. The market already knows Unilever's strengths. The stock isn't on sale anymore. For now, the price is right where it should be. The lesson? Markets look ahead, so should you. Let's talk about why this can be a double-edged sword. Ironically, a stock's strong performance can trigger a downgrade. If you bought Unilever earlier, you're sitting on gains. Congratulations. But for new investors, the higher price means less room for future returns. The risk-to-reward balance has shifted. Analysts look for value at today's prices, not yesterday's bargains. A strong run makes a stock more expensive, not necessarily more attractive. The downgrade isn't about Unilever getting worse. It's about the stock getting pricier. This rewards current shareholders, but makes new buying less appealing. The wave of gains has reached the shore. Now, expect calmer waters. Let's see why hold can be a smart move. In a world obsessed with action, hold can feel boring, but it's often wise. A hold rating means you likely bought a good company at a fair price, and now the market agrees. For Unilever, holding means you keep benefiting from its stability and dividends. Dividends are a steady reward for patient investors. Selling just because of a downgrade means giving up future income. Timing the market is nearly impossible. Holding lets you ride out short-term noise. A downgrade for valuation reasons doesn't change the long-term story. See hold as a sign of a solid, fairly valued company. Patience is powerful. Investing is a marathon, not a sprint. Let's talk about what to do when you see a downgrade. Your stock gets downgraded. What now? First, don't panic. Selling just because of a downgrade hands control to someone else's opinion. Instead, ask why the downgrade happened. Is it just valuation or something more serious? If it's about price and your reasons for owning the stock haven't changed, stay the course. Review your portfolio. Are you diversified or too concentrated? A downgrade is just one data point, not a crisis. Use it as a chance to review your strategy and risk. Stay focused on your long-term goals. News like the Unilever downgrade isn't a threat. It's a chance to get smarter. Every time you respond with reason, not emotion, you build your financial strength. The market isn't just noise. It's real businesses and real people. Strong investors know why they own what they own and don't get rattled by headlines. Analyst ratings are opinions, not orders. Your plan and goals matter most. Secure investors are patient. Wealth builds over time, not overnight. A hold rating is a nod to quality and patience. Let your investments work and let compounding do its magic. Promise yourself to keep learning and never let headlines control your decisions. The more you know, the more power you have. Be the smart, strong, and secure master of your financial destiny.